Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market5. I'm your co-host Joel Alcano, along with Brianna Valesky, and we have Scott Redler on the line. He's chief strategist at T3 Live and T3 Trading Group. He's back after a week hiatus from the show. Scott, how was your vacation? Did you do something fun?
Yeah, actually this weekend was great. Went out to Matatuck. The weather was beautiful. They have some wineries out there. A little cool, a little cold for jet skiing, but enough to do for the kids to keep them active. So it was great. Thanks for asking.
And so let's talk a little bit. You take a little bit of time off and you come back and stuff. Do you try and, do you clear out your positions and start fresh? Look at the charts. Just walk us through your routine a little bit when you take a little break or, have a long weekend from the markets.
Well, I think actually 2 weeks ago, that's when I took, I'm trying to think of the last time, was right before I left for that 100-mile race in Florida.
Wow.
Okay, so that was, I think, a different environment. If you remember, I believe I wasn't on that Monday, and that was the Monday after, I remember, I think it was May 14th when the S&P had that igniting bar and we closed back above 2117. So right there, I think I wasn't on that Monday, so that was the week I wasn't there. And at that particular point, I felt as if the market was ready for a nice breakout, right? We've been trading this range. It's been tight, and we closed above 2117, 2120. So I actually took about 8 longs with me, when I went to Florida, saying, you know what, I'm an active trader, but I also am a swing trader. So let me be a swing trader and take some positions as I think we're going to sustain a breakout. Let me have it a little mixed, so I'm not all concentrated in one area. And check every day, put some stops in around 10 o'clock or 10:15 after the first 30-minute range is established, and let the positions work out, because the market can make you some money when you're not in front of your computer screen just over actively managing them. So that was that week, and I believe I took Baba with me, who was trading in the 88 range. Apple, when it broke above 127.60, I was in that first swing trade. Citigroup, I think I had 54 as my key area. I've been holding Altira. And then I think I had the IWM. So I tried to trade or hold 6 of them, or actually 8 of them. And some worked out well and some didn't. But overall, it was good to be away and be able to make money. And as far as recently, I think, in front of the long weekend, Memorial Day, I sent out a tweet on Friday late afternoon that I was reducing some risk just because, there saw some mixed signals with the transports being so weak and, some high beta a little faulty. So I went from like 8 positions down to, 2 or 3 just to, have some risk off so I can enter the week, a little bit on a more flexible ground.
Yeah, it's nice. Sometimes when you're away from the screen, you're not making those decisions based on the shorter term charts. You're looking at a longer term picture, and you trade with your stops. You have you're in, you're out, whatever. You have your target, so that's a good way to trade too. Just wanted overall. I mean, I got the spider here. You can pull up the spiders. You can pull up the S&Ps. You can pull up the Dow Jones. All the charts are saying the same here. We are just in a tight consolidation phase. Basis the S&Ps, 4 highs in a row in that 2130 handle. Really haven't been able to crack 2115 on the downside and all that trading. Multiple closes around 2125, Scott. What is going to get this market out of this boring trading range?
Which depends which way it resolves. Some people say headlines are based on the action. Some people say the action is based on the headlines. And right now, at least we have a tight range. As traders, that's all you can ask for. We have 2122-ish or 2120-ish as support. So if you trade actively, that's the 8-day. If we were to break and close below that today, some guys probably reduce risk, go into less positions, and some might even try and be short for what could be a quick air pocket move down to the 21-day, which is 2107. So on a very short-term active basis, I know for me, I'm going to see, can we hold 2120. If we can't, then, it wouldn't even be unhealthy, I guess, if we test 2107, because that's still only the 21-day in the S&P. But if today we go from, say red to green, and we hold in there again, and next time maybe you add to some longs is when we break and close above the top end of the range, which is 2134. And then with that said, you have people in both camps. You have guys watching the transports saying, wow, transports are below the 200-day. This means the market's going to fall apart. It's something to recognize, but it's more importantly to recognize that if you were long the transports, you're not doing something right. You look at the chart I sent on the IYT, you see, active traders, or at least I talked about selling your swing longs if you break and close below the 8 and 21-day moving average. So that was like March 23rd, March 24th. That's when the transports broke, and that was almost, a month and a half ago. And now the IYT is sitting below the 200-day. So it's a different time, a different area. And if it stays below the 200-day, for my rule is like if it stays below for 1 or 2 sessions, tops above, sometimes it's like a sell trap. They get the last longs out, and then it starts, a new upside move. But if it stays below for like 2 to 5 sessions and there's no interest below the 200-day and the shorts can stay there and no one comes in to buy that dip, then you could see, more weakness, and that probably could be troublesome. So if the IYT can reclaim 154.50 in the next, coming few sessions, or if today it goes red and takes out right now oils because some of the airlines are up or whatever, but the IYTs take out the low here of, what was the low, 151.65, there's really nothing to the left for a bit, and that probably would raise the volatility, and I don't think the S&P will be able to hold the top end of the range if that takes place.
What words of advice do you have for people that are trying to pick a bottoms in the airline sector? Got shellacked last week. I guess you could kind of blame it on Southwest Airlines, who was talking about increasing capacity. Increasing capacity could read the price wars. They took these stocks out and they beat them. And the buy the dip mentality, even Barron's was echoing a little bit in American Airlines here.
Mm-hmm.
I mean, very dangerous here to try and catch a falling knife, especially in some of these stocks that have just been Wall Street hedge fund favorites for so long. The herd mentality. Let's talk about some of these individual airline issues and what would you be looking out for? Let's start with Delta Airlines.
Okay, well, last week, unfortunately, a lot of my traders did try and catch a little bit of a bounce, and they got hurt because they started too early. They started, I believe, on Wednesday, and Wednesday was not the day to start looking for a bottom in the airlines. I actually, smelled a little bit of the blood on Thursday, and I said, my morning note, I'm not going to just buy every level down because you never know what's going to happen, but a level versus a level. And if you look at something like, first start with, Delta on that Thursday, okay, gave you a small red dog reversal, okay? If you look at the level there, it broke below Wednesday's low. Wednesday's low was 43.16. It put in a low on Thursday at 42.69, and then came back above it and closed okay. So that was your first little red dog reversal, saying, okay, if I wasn't long from the upper end of that flag and around 46 or 47. By the way, look at that outside day. Look at the outside day on 519. That outside day right there told every trader in America, get out of Dodge, at least if you're a technical trader. That upper flag failed and closed through the low engulfing 5 days. You do not stick around for something like that. So if you happen to have gotten out there, if you were trying to play for upside, then you had the luxury of testing lower. So anyway, that Thursday you had a small RDR, and sometimes it's just a trade. Sometimes it creates a new move. But if you look what happened on Friday, it closed right back down on the lows of the day. So some guys would probably just say, if they held the third from Thursday into Friday, let me just call that a wash. Or some say, okay, I'm going to give it all the way to the low of Thursday, which is 42.69, and you still have some room. For me, if I didn't actually hold the trailer. I was just, I'm not that active in the airline, so I was just using it to trade. But I looked back on Friday, I'm like, wow, these things don't really look good. But then also, again, another clue, look at UAL. UAL, look that thing sliced the 200-day, okay, which was the 200-day, what was that, around 59. And then I actually tried playing that one also on that Thursday, which that bounce was horrendous. In the morning, there was a quick little trade, and then it closed in the lows and made new lows on Friday. And if I was looking at something like just a Delta that's hovering on the 200-day, and then you look at something like United that got crushed through the 200-day and didn't even get a bounce, I would just be a little careful saying, if it happened to United, it might be able to happen to Delta. So that would be in the back of my head. And then you look at JetBlue, which, it's shown relative strength, a lot of relative strength. It's only at the 50-day, but, I think in my mind, if more carnage happens to the other airlines, they come for everything. And, this, I would be very careful. And what I would do is, coming into this week, if you're long JetBlue, I would say give it to 2003,
yep,
which is that Wednesday low, And if it breaks that, just get out of the way.
Yeah, I mean these things, once they get going in one direction, it's hard to stop it. Let's talk a little bit about the financials. That got a little bit of the bright spot in the market. We probably would have broken down last week if it wouldn't have been for the financials here. Decent earnings coming out of them. Maybe interest rates going up might be a little bit of a good sign for them. Let's just look at the XLF and get your take on that.
Yeah, I think in the last month or two we talked about the strength in the financials and talked about if Golden gets above, 201-ish, it could get some momentum in that group above 192. The chart of Goldman has been great. The XLF itself, a lot of the bears were talking about a potential head and shoulders pattern, but that got pretty much negated when the right shoulder pretty much sliced above, what was this, like 2460? That would have gotten me out of the bearish camp if I was trying to be bearish there. And it's been riding the 8-day right back at highs. And when the financials are moving, whether you want to believe that they're moving for real or not, it helps the market. It's hard for the market to break down when you have Goldman Sachs trading at multi-year highs, and you have J.P. Morgan near multi-year highs, and even some of the other ones participating. So we'll see if that continues. There's a lot of hope here that rates are going higher. At this point, just remain technical with them. As long as they continue to follow the trend that you trade, stay with them. And right now, you look at the chart of J.P. Morgan, it's been above the 8-day moving average since mid-April. You look at Goldman Sachs, it's been above the 8-day moving average since mid-April. You look at Morgan Stanley, probably the same thing. Above the 8-day since a little bit later April. So I would stick with trends there. And if the financials start to weaken a little bit and the transports stay weak, then I think that maybe there's some downside probing, but we'll see what pulls what at this point. Divergences has been the name of the game for 2 years. We've had rolling corrections, and within those rolling corrections, money's gone elsewhere, which has helped support the move in the S&P and the Dow, where they haven't had real corrections.
Let's move on to some issues here. Apple got the icon boost last week here, beat up after earnings, crawling its way back, showing green on the screen here. Despite the SPOOs trading down 7.5 points here. Are you just going to ride this thing up to all-time highs here? Are you chasing here if you're trying to get it at this level? I mean, if you listen to, Carl Icahn's going to 240. What's your take on that?
I think the last time I posted a chart on Twitter, or one of the ones to focus on, was 514. If you look at the chart on May 14th, when the stock had that igniting bar and cleared 127.60, okay, that was my point that I said Apple is back, and I could be in a swing trade and try and trade around it and trail it versus being a choppy mess, which it's been since earnings. But since then, the stock has had a nice move, and it's back at highs. It's one of my few longs that I kept because it did show relative strength on a Friday, also where I thought they would pin it lower for option expiration. They couldn't even do that. So I'm in Apple, and I'm going to try and hold it. Does it blast off through the old highs, which is like 133.60, to that reversal high on earnings, 134.50? I'm not sure, but that's like almost like the financials. The market's going to have a hard time breaking down if Apple all of a sudden clears 134, to 134.60 and makes new highs. It's a big component, but it's acting healthy, and when Apple's acting healthy, I try and be in it. It's above the 8, it's above the 21-day, and it's worth holding. I would say for me, I would use 130 to 130.50 as a stop if it were to break and reverse lower below that. Then I'll probably back the day-to-day on Apple. But for right now, I'm trying to stick with the trend that's been intact since that big move over 127.60.
So how your traders been doing in Shake Shack?
Well, I think a lot of them started to back off a little bit as it got extended. We sent out notes on Shack when it went above 52. You want to look at a new issue. New issue is all about supply and demand. It's not about valuation at the beginning. It's about who has shares, who's short, and how does it trade. And if you look at the chart of Shack above 52 when it took out that IPO high, what a nice move. Went pretty much in a straight line to 77.50 before it corrected. And then you could see it came to the 21-day, and that was on May 8th, held it with a little red dog reversal, and then came all the way back towards that pivot. And then the last real pivot buy for traders was 79.50. Look at that chart. And then you had a nice breakout day, another breakout day, and then on Friday, I sent out a tweet saying, if you didn't buy it at 52, if you didn't buy it at 62.50, if you didn't buy it at 78, you better check your process if you're paying here at 94 because you'd be in a lot of trouble. I actually kind of got lucky that I had a locate on it, so I had to pay to be able to short it on Friday, which was a nice trade. And now I think, long should avoid, and, it's tricky to be short. It's hard to get a locate, but at this point, I think the move was mechanical. So many shorts trapped, so little shares out there. Kind of reminds me of what happened with G-Pro when G-Pro went from 45 to 95. If you made money long this thing, hopefully you reduced on Friday, and I still think, around 90 reduce and let it work its way out. And if you can get short and handle it, stock could see the low 80s pretty quick.
Have you ever had a Shake Shack burger?
Yes, I have. Unbelievable.
Really?
I'm not a sweets guy. I'm a grease belly. I love a great hamburger and French fries or a steak sandwich and well done fries. So that's why I think I run hundreds of miles just because I love that stuff. But
Yep.
Shack is special. It
Oh,
definitely is.
really? $50 million of franchise here. I mean, that better be. It better be. Then Chicken Shack and Fish Shack, they're doing all the things. All right, a few more issues to run down here with you. Tesla kind of stalled here at the 250 level. What's your thoughts on Tesla?
I think it's been acting well since clearing the descending channel at 207, and then it was able to absorb earnings, absorb that recent event with the batteries. And I think for a trader, short term, if it stays above 241, stay long, and if it could continue to get a little tighter and the market hangs in there might even be another pivot trade to the long side if it can clear 250 again. But I would put stops in around 241.
Okay, and we got to discuss Alibaba here. Waited and waited and waited. If you didn't get in on the earnings day, had earnings day range held up for about 7, 8 sessions here. Did you dabble in it before it broke out of that earnings high? Did you get in there and just not worry about the gap fill? And then the news last week sent it into orbit. Give us your take on Alibaba.
And this is a good lesson, even for an experienced guy like me, because before I left for Florida, if you look back on what day was that was May 14th, okay, or right around there, I was in max position for me, anticipating that it would break above that 89 and change. I was also pretty much max position in Apple, too, saying, okay, with one of my 8 positions, I'm going to hold it and let it work out while I'm gone. And all of a sudden, I leave for Florida, and then run the race, and then on Sunday, I'm sitting in my car driving, and I see one headline from CNBC is Third Point gets rid of its stake in Alibaba, and then a little bit later in the afternoon, I see Gucci sues Alibaba for counterfeiting this and that, and I said to myself, oh my goodness. And then also there's news on Apple too that some of the big guys reduced their stake. So my 2 top positions I'm reading about, and I'm like, this is not fun while I'm away trying to run a race and support my cousin, etc. So for me, on Monday, I said in my head, I'm like, let me just reduce half my position in Baba, and I'll put a stop in, at that 86 level, where the earnings gap was, just in case it falls apart. It was down $1.50 that day, and it opened down $1.50 and stayed there the whole day. And then, the next day, it took off above, that 89 and change and didn't look back. But because I had too much while I was away, anticipating my momentum tier size, I wasn't able to get back into it for the breakout. So I did make money back. I just didn't make as much as if I closed my eyes, didn't read the news, and let it work out and show up back to my desk on Wednesday. But anyway, just shows you that, you have to have the right size with the right idea and trust stops, because it never violated that earnings gap, and never even, didn't even go below 86.40-ish. So there was never any reason to sell, except for if you had too much and you listened to all the banter on TV about how it was going to crush, and it didn't, obviously.
Great lesson to be learned there from Scott Redler, Chief Strategist at T3 Live and T3 Trading Group. Joins us every Monday, but a Tuesday this week to discuss his short-term strategies and also his longer-term outlook on the market, which is very good. Scott, glad you're back. Have a great day, great week. We'll talk to you next Monday.
Thanks for having me, and good luck to you as well.